As long-term investors, we're all here for the same reason. And that reason is to find out, can we hit our investing goals and can we find the stocks, the investments to lubricate our returns to hit those goals. Now, I thought WD-40 could be an interesting investment and a potential way to hit that as a kind of very boring, long-standing company. And I think those are sort of the best ones sometimes for long-term investing. So I'm going to present to you in this video my overview, or rather an overview, of my findings for WD-40. Please remember, as always, I'm just a random guy on the internet, so don't take this as personalised advice for you. Before we start, please comment below because I want to hear your very best investing puns on WD-40, and the best WD-40 related investing pun I will send an investment book to. So now that we've got that audience participation sorted, let's start the review. Here is my overview of WD-40. Here is what WD-40 do. They make high quality products, specialist products for applications such as degreasing and lubrication. So my gut feel was that this could be a quite kind of boring, underrated company by the market. It's not the sort of thing that's going to grow very quickly. So let's start off by looking at the quality of the company. We are looking at the TIKR terminal and at the 10-year financial history, and we can see quite steady revenue growth over the period to around about $500 million in the most recent results. Now in this period, we worked down the gross margins are consistently around about 50%, which is a pretty decent number, and the operating margins are in that sort of 15 to 20% range, currently at 15.6%. So pretty good, although not exceptional. Now here is the return on capital employed, the key metric over time. And the first thing to note for me is that this value is consistently over 20%. Pre-pandemic, it did actually go towards that 30% and exceed 30%. And we're now at around about 25%. So consistently over time, this company is very good investing into itself and generating returns. Question will be, how much scope is there to do that because of the limited growth of the kind of stuff they do? So I suspect they'll be doing some share buybacks and or dividend payments with any excess earnings over and above what they can invest back into themselves. So we've established at a very high level that this potentially is a quality company. The prudent thing to do would be, is this likely to fail? Could they fail? So I'm looking at the interest coverage. It's generally been a very good metric. We're at 19, which is about as low as it's ever been, but 19 is still a good figure, so I'm happy with that. And also the debt to equity. See the debt to equity here, that is consistently below 100%, apart from a blip in 2017. We're looking at sort of 80% at the moment, so that's fine. Not amazing, but it's fine. And then finally, the current ratio, effectively their short-term ability to pay their bills, that is over 2, and it has been over 2 for several years. That's a good value. So my assessment at a high level is that this company is probably unlikely to fail. Let's have a look at the dividend. So the dividend per share, we can see has been going up over time, and if we look at the growth rate, that growth rate per year in most years is around about 10% or more. So that dividend is growing pretty rapidly. And the payout ratio, the line below that, is generally pretty affordable. Not super low, but reasonable. Generally below 60%, although in the last set of results, we've got to 62%, and then the trailing 12 months we're up to 72.5%. So a touch higher than I prefer, although not necessarily alarming at this stage because it is quite a stable, consistent company. Now looking at the shares outstanding, generally speaking, that's been dropping by a small amount each year. They're not doing excessive amounts of buybacks. There have been some buybacks in the past. So that all adds into your total return as a shareholder. Just to flick over to Simply Wall Street, just to have a look at the graphical representation of the dividend, because that's sometimes easier to see. We can see here the lighter line, that dividend going up, and the yield variability there as well. That current yield is 1.7%. fact, the big news on the 21st of June is that the quarterly dividend has been declared. So you have got until 14th of July for that next dividend date. So if you're interested, go act quickly. So guys, I want to sort of valuation, and free cash flow is a very suitable way to value this company. And the first thing to note is the free cash flow figures have some oddities to them. If we look at the historic values of free cash flow, that free cash flow has generally been creeping up to around about $70 million. You can see the trailing 12 months were actually only at 11.5. And the reason for that, I believe, is in their inventory piece. You see the change in inventories is much, much larger for the last two sets of results, which has been impacting their free cash flow. So you get a kind of an artificially low free cash flow number. And just to make that clearer, what we can see here on screen is that an increase in inventory stock will appear as a negative amount in the cash flow statement, indicating a cash outlay or that they purchased more goods than they've sold. So that's what's happened here. This could indicate an issue. So have they bulk ordered because of supply chain issues, or is there some kind of underlying issue that we're not seeing? That point may need further investigation. What I've done in my free cash flow calculations, I've actually used a figure of around about 70 million. So I've normalised based on the 2021 figure, because I think that's probably a more reasonable figure to use. Growth is a component of the valuation. And we have here on Yahoo an estimation of 10% per year growth for the next 5 years. Simply Wall Street indicates around about 13%. I'm going to be conservative and use 10%. So using that and calculating a range of scenarios using a 10% and a 15% discount rate and a 5 and a 10-year period, I've come up with a potential return that I think this company could make if I invested in it at the existing prices. And I believe that return is from the range of minus 4.4% a year to plus 10.4% a year. Quite a wide range. Now, for those of you that follow the PE ratio, I'm not one to put a massive amount of credence to the PE ratio, but it does give an indication in some cases. Now, that is 44. And free cash flow yield, if you think 70 million, we've used that figure, against 2.6 billion, we've got a company that is quite overvalued at the moment, probably, hence the low-ish rate of return. So for me, it looks like a good company, not a great company, but a good company. And as a good company on my shortlist, I think, for investing, it's not one I'm going to rush out and buy, particularly that rate of return range. I want something that said it was going to make between 10 and 15% a year rather than minus 4 and 10%. So for me, WD-40 is not going to grease the wheels of my portfolio return. It's not a buy, but I do hope that that overview has been interesting for you if you were considering looking at this company. And if you've never come across them before, hopefully that's given you a little bit of an insight. Thank you ever so much for watching this video, but please stop there, because I'd urge you to consider clicking on this video here. This video is another stock that I've reviewed, and if you're looking for additions to your long-term investing portfolio, it might be worth taking a look. I'll see you there.